Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. China's most valuable company is set to report earnings, and investor focus is on Tencent's AI push in an increasingly competitive market. Meanwhile, Bloomberg learns that Beijing is urging local firms to limit the use of Nvidia's H20 chips, seen as critical to China's AI development. We'll ask an AI policy expert whether Chinese-made chips from Huawei and others can really replace Nvidia and AMD. As stocks rally on hopes of a Fed rate cut, we speak to BNP Paribas Wealth Management's Asia CIO about which regional markets could benefit most. Plus, India and China resuming direct flights after more than 5 years as both sides look to reset ties in the face of their souring relations with the US. Well, AI will be a big focus for investors today as China's most valuable company reports earnings. Tencent is set to release its second quarter numbers, with analysts expecting its slowest profit growth in over a year. The company is grappling with a number of challenges, from slowing consumer spending to ongoing chip tensions with the US. But the big question is how these factors are impacting its ambitious AI growth strategy. Well, for more, let's go to our China correspondent, Min Lo in Hong Kong. Min, what are we anticipating?
Yeah, there are two big revenue centers for Tencent, right? One is the gaming and the other is the ad revenue. But of course, Tencent is likely to be relatively shielded from the tariff impact, but it might feel the second order impact on the economy if it slows down. That could have an impact on its ad revenue. As you said, AI spending is something crucial to watch, especially whether that contributes to increased advertising revenue on its video account services. But in terms of the gaming pipeline, I think investors will want to know what's in the pipeline for the next 6 to 9 months, especially because we know the Chinese government has been speeding up the approval of games, and we know it has a new mobile game that is due to launch soon. The PC version is already out and is contributing meaningfully to the gaming segment revenue. And investors are actually pretty hopeful. We are looking at a double-digit increase in revenue. 11% is the forecast. That will be the third consecutive quarter of double-digit revenue, even as we expect earnings to start to normalize this year to the mid-single teens digit level. But because the share prices have been so cheap in terms of valuation, if you compare it to its peers like Nintendo and Sony, it's now trading about 17 times price to earnings ratio. It's considered very cheap. There are some hopes that maybe Tencent would be able to see its share prices hit historical highs after the earnings, a matter of time. Yeah, you can see here on this chart that earnings... Yeah, you can see here on this chart the earnings are hitting record highs, but share prices are still 25% below the peak, so a lot of room for growth there.
That's right, and could be a catalyst for H's tag. Tencent's progress on AI is one of the most closely watched factors for the market. Could we see any guidance whatsoever related to the current concerns around access to Nvidia's H20 chips?
Yeah, definitely. This is something that we'll be looking out for during the earnings call because, of course, it would affect their capex spending on AI investment. Of course, we know that the H20 chips, the export licenses are finally coming through. But we understand from Reuters reporting that Tencent was among the companies that had been summoned by regulators who are questioning these companies. Why are they choosing to buy H20 chips as opposed to the domestic homegrown chips, and whether they noticed any security risks associated with that? So does this mean then that private companies like Tencent would choose to reduce or stop their purchases of H20 altogether to switch to local chips? And what does that mean for their AI development? Because so far we know that the H20 is still by far the most advanced chips that Chinese companies can get their hands on. And even though local chips have made some leaps and bounds in qualities, it may not be as versatile as the H20 when it comes to the specific workloads that is needed for AI. So this is something that we'll continue to watch, whether or not companies like Tencent are going to shift their buying pattern when it comes to these US chips, because it could also set a precedent for other tech companies as well.
Great reporting there, Min. Our China correspondent Min Lo in Hong Kong. As investors focus on China's AI progress, sources tell Bloomberg that Beijing is urging local firms to avoid Nvidia's popular H20, especially for government use, while Chinese officials have sent notices discouraging use of the less advanced chip. It's not yet an outright ban. Industry analysts broadly agree that Chinese companies still need the Nvidia chips to run some key AI applications. Long-term Nvidia investor Ross Gerber also weighed in on the situation earlier.
There's no way around Nvidia at the moment, and so China's in kind of a pickle. This is a strategic advantage the United States has in technology, which is what we've always had, and why I've always been a technology investor in the United States.
Our next guest thinks this move by China signals that domestic alternatives remain inadequate, even as it pressures foreign suppliers. Lennart Heim is an associate information scientist at RAND. His research focuses on advanced AI systems with an emphasis on policy development and security implications. Lennart, good to have you with us. So for all the pushback we're seeing from China in terms of H20 chips, China needs these chips, at least for now.
Absolutely. If we look at China's AI ecosystem and in general their semiconductor ecosystem, they've been trying to build their own semiconductors and they're doing so. But the best AI chip is still significantly worse than Nvidia's chips, right? If we look at their best AI chip, the Huawei Ace 910C, which came out roughly in this year and the first companies are using it, it's only 80% as good as Nvidia's chip, which came out 2 or 3 years ago, right? So it's still lagging behind in terms of how good the chips are, but most importantly, how many chips they can produce. According to a testimony of Undersecretary Kessler in the United States, he said Huawei can only produce 200,000 ASIN chips, versus we've seen reporting of them selling up to 1 million H20s.
So it is a matter of capacity. How about a matter of quality? Those H20 versus what's produced in China?
Both go hand in hand. So if you have worse chips, you can make up with this by just buying more. But if you cannot produce that many, you can't really make up for this. And this is just looking at the numbers. There is way more to AI chips than just the numbers. All of these companies, all of the big tech companies in China historically have used Nvidia chips. This means if they want to switch to these Huawei chips, they need to change their software stack. They need to redevelop software. And this just costs time. And then there's more things which are not captured in numbers. We've heard about overheating issues with these chips. You need more of these chips. Then the software ecosystem is not as mature as the chips. You see the same in the US. For example, Nvidia's competitor AMD has only like a tiny market share, less than 5%, despite on paper producing really good chips. So everything around the software ecosystem, reliability in there is like key, and Huawei there is lagging behind.
The thing is, China's also expressed the same kind of security concerns as the U.S. Are there vulnerabilities for China when it comes to using those H20 chips from Nvidia?
I personally assess this as pretty unlikely, and this is not the first time about these H20s. I don't know what triggered this investigation in this particular moment. There are currently discussions in the US, a so-called chip security bill, where they propose that certain chips are equipped with a location verification technique. But the idea was not for this equipping this to chips which go to China. The idea was to equip chips which, for example, go to Malaysia to make sure they don't end up in China, right? And again, and all of what this technique would do is like verify the location. There is no remote off switch more being proposed there. And NVIDIA themselves came out saying that they, again, produce secure software and hardware here. But it's nothing new. We've seen China generally becoming more skeptical of Western technology, and we've seen in the past also the government usage of CPUs, where they used to buy Intel, also pushing towards like domestic alternatives here. So what I mostly read into this here is like creating some domestic demand for these inferior chips, but like pushing slightly in this direction to eventually in the long run have a transition to like their own domestic stack.
The U.S. has said, Lennart, that it is mulling over location trackers to ensure that their chips don't end up in the wrong hands. I'm just wondering, how might this play out? I mean, might players like NVIDIA be forced to include this in their chips, and what the implications might be?
To be clear, this is right now only like a proposed bill, which is being discussed on the Hill, as we say here in D.C. So it's not clear it's going to pass yet, and people weighing differently here. It's the case that the AI Action Plan, which came out and was announced by Trump, David Sachs, and many others, they said that location verification might be one thing they want to equip chips with. But the idea here is to prevent smuggling, right? So the idea of these chips is like, these chips would be equipped when they go to Malaysia, UAE, and other countries where the US government is concerned, these being like smuggling hotspots. And then you could verify if they end up in China. There's still nothing you can then do about it, at least if you go with the current bill text. So the security concern here is, again, it's not about the chips which go to China. The H20 is a chip which is only designed for China. The location verification would not help you here, and there's no proposal which talks about chips going to China having a location verification feature.
How do you do this in the first place? Is it via the software? Do you make changes to the chips itself? You're the scientist. I mean, help shed light on how this can be done.
I mean, there are different proposals here. I think many often think about GPS, but GPS is clearly not a good idea here because this can be easily jammed and like even changed. The idea, I think, I'm not sure what they actually say exactly in the bill, but there have been technical papers out there which propose something which is a ping-based location verification. So you talk to multiple data centers which are spread around the world, and depending how long it takes for the signal to travel, you can basically triangulate where the chip is, right? And this is then usually right within like within some error range, you can tell at least if it's in Malaysia, for example, does it end up in China. But again, this bill does not exactly lay out the tech what you need to do here. But what technical specialists have said, they're pretty confident that Nvidia could implement this if they wanted to, just via software, via firmware update. You don't need to create new hardware for this.
There's so much talk and perhaps, questions around AI leadership. And some say that, China is closing that gap. Give us a sense of what's a true metric for AI leadership and where does China stand right now?
It's clearly contested what the best metric here is. And as a scientist, I must say, there is not a single best metric. I think what many focus on, and this is where this DeepSeek moment came from, is you look at benchmark performance. How well do large language models perform on these benchmarks? And then everybody saw DeepSeek being pretty good, right? Close to the best models coming out of the US. I think a metric which I've been putting forward is like, let's look at the total compute capacity. How much room is there for training and deploying AI models? And there the US is clearly leading. The US produces significantly more AI chips. These chips are significantly better, and it houses the most supercomputers in the world. Recent studies, which some colleagues of mine did, basically found that the US hosts, I think, 70 to 80% of all AI compute around the world, and whereas China is in the 10 to 50% range. They're second, but the US is clearly in the lead here. And the export controls the US has done, starting under the first Trump administration and then enhanced by the Biden administration, they stopped China from producing better AI chips, and they will continue struggling in the future. They will definitely get better, but catching up with the rest of the world here will be significantly hard, in particular if they don't have access to the most cutting-edge technology and if they can't buy the best AI chips. That they now can buy this Nvidia H20 changes the equation a tiny bit. The H20 is not the best chip out there, but it's a really good chip for AI deployment, right? And this will make companies like DeepSeek and others more competitive because they can now deploy AI systems for cheaper and sell access for cheaper here. This means every chip which goes there makes at least these companies a bit more competitive.
And if you're right, Lennart, that the U.S. is leading by a mile, could the U.S. be overreacting to China's AI development?
It depends how far you want this gap to be. And I think, again, there are many metrics. I said we're leading by a mile if we look at total compute capacity. But if you look, for example, to lead how good individual models are, the lead is not that far. I think we're talking about half a year here, a couple of months if you look at the best performance here. And then I think just one needs to be cautious here and take all of these different metrics into consideration here, right? How good are these models? How much capacity do you have? But also, how much are you diffusing it across the economy? And I think many have reasons to believe that China might be better at diffusing across the economy. And also going forward, in the US, energy is a big topic. It was a big topic part of the action plan. And China is clearly way better at building more energy capacity, which helps them to fuel more AI power in the future, whereas the US is struggling here, right? So this is not clearly over yet. There are many metrics here, and the sum of it might matter. And it also always depends on what true leadership means here. People have different opinions.
Right. To that end, I spoke to a White House official just last week, and he did say that the next trailblazing breakthroughs in AI will be made on American tech. Can you be so sure of that?
I think that's fair to say. we talked about Huawei chips, we talked about Nvidia chips. If you look at most leading AI models in the world, even those stemming out of China, the majority of them were trained on Nvidia. DeepSeek trained on Nvidia. So we don't see leading models being trained yet with Huawei and ASIN chips. And even then, it depends how far you go with US tech. Even the Huawei ASIN chips are still being built on machines. They're built by the Dutch, by ASML in the Netherlands, but they build on top of US technology. So US technology is everywhere in there. And this is also how the US is weaponizing it via these export controls and not allowing it. So again, depends on the definition where the US tech is in there, but it's all over there. And then AI is still an open science. People still publish papers. People get new insights. When OpenAI comes out with a new model, we don't know all of the details, but people learn more. How much this model costs, what OpenAI announces, and these kinds of insights also diffuse. And of course, others are building from it, but also the other way around, of course.
Lennart, so much perspective there. Thank you for joining us today, RAND's Lennart Heim, sticking around as we discuss the implications of AI startup Perplexity's massive offer to buy Google's Chrome browser. Let's do a check on how HS Tech is doing. It is rallying as much as 2%. Remember that some are saying that Tencent's results could provide the catalyst for HS Tech, currently up by 2.2%. Keep it here with us. This is Bloomberg. Welcome back to Insight. AI startup Perplexity has made a $35 billion bid to acquire Google's Chrome browser. The offer comes as Google faces antitrust pressure and potential forced divestment of Chrome. Perplexity is seeking to leverage Chrome's user base to gain an advantage in the AI search race. Let's get back to Lennart Heim, Associate Information Scientist at RAND. Lennart, I mean, this is a bold move. It's a $35 billion move. Why? When Perplexity itself has its own web browser.
To be honest, it's also for me the first time I'm hearing this. I mean, the user base of Chrome, it's the most popular browser in the world, right? And everybody's using it. And if you can integrate AI there, and if it's this general purpose tool, which people claim it is, it seems like a pretty bold and good business move to get a big user base, get everybody use AI, and trying to integrate it. So I think they might try to make use out of this antitrust case.
Would you say this is a long shot, Lennart?
It sounds like a long shot. I think there are, again, I'm not an antitrust lawyer, so I can't really speak to the substance here of what should be happening and if this is like the right case. But Perplexity is a rather young company, right? And Chrome is like sitting, it's been there for a long time. I guess just most other tech companies will also face antitrust. And Meta and Apple, all of them probably would love to buy Chrome, but probably they can't. So for an AI company, I think it makes sense. This would be the perfect way to get a user base and a perfect way to integrate it. But overall, it sounds like a long shot for them to get it. Again, missing the exact details here of how and where this is happening.
And what's in it for Perplexity? How do you think, it might really gain the benefits of paying $35 billion for Chrome?
We already see companies like OpenAI and elsewhere. They also put out I think they also call it browser, that tool. So the idea is just like you have an AI navigating the browser. The best example of this is an AI at some point should be able to book my flight tickets. And the way of going about it for now is I get the AI to open up a browser tab, go on the booking website and click around. And if you natively integrate all of this and it does that and it works well, this would be a huge win. And I think right now Google might be a bit nervous to implementing Gemini itself into the browser because this might make the antitrust case even worse. But we see Google making a move of integrating Gemini everywhere else. If you start opening up Google Workspace and start writing a document or Google Sheet, Gemini is integrated everywhere. Apple has at least been trying to integrate AI everywhere. And again, the browser is the portal to the internet. And having AI in there, again, I think the business case is pretty clear here. And it's the portal to the future. And then integrating AI there might only help if it then works.
Of course, the allegation here is that, it's anti-competition. I'm just wondering how Google might respond to it. What measures can Google take to perhaps allay those concerns?
I mean, I already mentioned it. Google right now is not implementing the AI directly into the browser. right? I still need to go on Google Docs, and then I see the Gemini up there. It's not directly integrated to the browser. So I think Google is trying to build more distance between their Google Chrome and the rest of their product line here. And if with Google come out tomorrow that all of their products are the default way when you navigate somewhere or even promote them on a search page or like in the tabs or like integrated automatically, I think this will make their case only worse in that sense. And I don't expect Google to do this move right now and rather build a little bit more distance here.
We know that for a company like Perplexity, it's, gaining recognition in the AI space. I'm just wondering how AI might change the face of Perplexity. What are the prospects for the company going forward, do you think?
I think Perplexity was like really the focus of attention a couple of months ago, but since then it's been going down because Perplexity was the first AI tool which allowed for search and using other websites to browse the internet. In the past, we had the problem where I prompted a large language model and only knew what it remembered, what it was trained on, but it couldn't read the news of the days. And Perplexity was this tool which then allowed this AI to read the internet, to get news of the day and put it together and write a summary, which is really useful. But since then, we've seen every single AI company doing the same. Google Gemini now supports this, OpenAI's ChatGPT supports this, Anthropic's Claude supports this, and also xAI's Grok supports all of this. So I would personally expect, again, without having checked numbers recently, the user base of Perplexity actually going down and them just facing more competition. And if I'm not mistaken, they also probably do not train their own AI big models, rather you contract with one of the big companies. So they only build like some scaffolding around it. But I could be wrong about it. I haven't checked it recently, but I think the competition has been definitely bigger and harder from, again, all the big tech companies.
And Lennart, in terms of themes arising from, AI, I mean, what are the biggest ones that you're keeping an eye on?
As we talked about in the beginning, right now we talk about chip export controls. The H20s being sold to China is a big topic in DC. And also the action plan. There are plenty of items where I think everybody's desperately waiting for them to get implemented and learning more about the details. Unlocking more energy in the US to build more data centers. There is discussion about more promote moves for the US to export more of its AI tech stack around the world. And there's also more guidance of removing woke AI. So we will see where this eventually lands, and I think that's what people have been following. But again, most of the time over the last few days, last few hours, the big debate export controls with this H20s being sold in return for a 50% fee, Donald Trump making this deal with Jensen. This is where my attention was at, and I can't wait to hear what we learn next.
And it is also interesting to see that AI startups like Perplexity are making such a huge impact in the world. How do you see all these startups shaping the AI space 12, 24 months from here?
There has always been a big discussion in the AI startup space. Are they like actually real AI, or are they just like so-called wrappers? Are they just using OpenAI's models and build something around it? And I think we've seen a lot of times that these companies, they've wrapped something around it. They did a little bit better than, for example, OpenAI's GPT-4 on a specific task. But then a couple of weeks later, OpenAI comes out with the OpenAI 1, and it just performs way better than all of these companies. So I think these companies, they have it really hard here. Because these big companies that build better and better models, in their niche case, their more narrow domain, which they're trying to accelerate AI to, just got surpassed by a model with like more general capabilities. So I think it's still in really an interesting space where we like see ups and downs on various different apps. Eventually, I expect companies will be narrow here and like push forward.
Great stuff, Lennart Heim, Associate Information Scientist at RAND. Coming up, we talk market strategy with BNP Paribas Wealth Management, including the Fed's response to the latest U.S. inflation data. Asia's CIO, Prashant Bhayani, will be joining us next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. The latest U.S. inflation readings for July are adding to bets for the Fed to cut rates as soon as September. While core inflation did accelerate last month, the impact of tariffs on goods prices was less than feared. The pickup in core CPI came instead from services, with airfares, medical care, and recreation costs rising. Let's discuss the Fed's policy direction and its impact on Asian markets with Prashant Bhayani, Asia CIO at BNP BNP Paribas Wealth Management. Prashant, good to have you with us. It does seem 90% priced in for September. Are you as convinced?
At this point, we are. There's still things to play for because we have a PCE data, inflation data, end of the month, and of course we have employment data beginning of next month. But at this point, there's enough labor market weakness from the non-farm payroll, those revisions, 258,000 jobs, that at least an insurance cut is possible. But the inflation data, we think will play out over many months. So in terms of super core inflation, ex-service, with the service inflation, it's still sticky. So we don't see 50 basis points as being realistic at this point ahead of the September meeting.
You say inflation cut of 25%. I'm just wondering, why do you think Besson is pushing for 50? He thinks the Fed should be open to 50.
Well, the Fed should be open to anything, of course, including raising rates, but obviously that's not realistic.
But that's on the assumption that the Fed is really behind the curve.
Yeah. I mean, obviously they have a view that the Fed's behind the curve, and I think this is also job owning. It's obviously 50 is a possibility. If you've got a very weak employment data at the beginning of September, say a negative payroll, then we can start to say they are too late and they should have cut earlier. We don't have that evidence yet. I think this non-farm payroll, the 258,000 revision negative, was a big surprise. But that's only 1 month. So what does next month come? And I think if that debate will obviously intensify if we get a very negative employment number. Some of the Fed governors are job owning. They're going to look more at employment than inflation. But at this point, the labor market is not excessively weak. There's just less hiring, not a great deal of firing.
The thing is, we're seeing the S&P at record highs right now on the assumption that CPI came in line with expectations, supporting that narrative for a cut. When you take a look closer, CPI is 0.2%, prices ex-housing 0.5%, which is the highest since Jan. That's not quite, a reason to be cutting. Some say you shouldn't be having cuts this year at all.
Yeah, in that scenario, if we get, for example, the PCE data ends up being more resilient end of the month, it doesn't look at this point based on the preliminary data, and then we get a payroll data which is actually positive again, and stock markets at all-time highs, you have an argument that it could be pushed out. You're right. So we are finely balanced here. I think either way, a quarter-point cut, what does it change? Does it dramatically change the trajectory of the economy? No. But the key thing will be to look at the long end of the curve. If they cut 25 and the 10-year yields increase, then the bond market is saying, actually, you are cutting too early. Right now, the bond market is fine. It's pricing in that rate cut. It's not a surprise. But that's what we're watching into that kind of scenario that you're talking about in terms of policy error by cutting too early as opposed to too late.
And that's even before the tariff impact comes to play. It's making it really complicated for central banks around the world. It's not just the Fed. I mean, we have the BOT coming up with its own decision today, likely to cut further 3 times in a row. I mean, do you see Asian central banks as well having to do this cut in anticipation?
Yeah, it's a good point. So the good news is the dollar is weak. It's been cyclically strong. So normally Asian central banks, they can't cut rates if their domestic economy is weak because they're worried about their own currencies versus the dollar. So the good news is this is a lifeline for Asian central banks in the sense that if the Fed's on hold or modestly cutting, whatever the scenario is, that's not a scenario where the dollar should outperform a lot. So then they can really run monetary policy more to local conditions and don't have to worry about FX outflows. So in the case of Thailand or other countries within Asia, they have more freedom to cut. And we've seen gradual cuts this year. And the key to me is the dollar, because a weaker dollar is a loosening of financial conditions.
How much can the dollar weaken from here? When you take a look at the U.S. economy as a whole, it does seem like it is still resilient. Fundamentally, it seems quite well supported.
Yeah, that's correct. We don't have a recession call for the U.S. We have slowing growth, around 1.7% GDP this year. But the dollar was cyclically strong. And you remember after Trump's re-election, we had a big rally in the dollar. So this year is really about, frankly, bringing down that dollar strength. We had a 50% move in the dollar, bigger picture, between 2009 to 2022. So right now, the dollar weakness this year is a little bit exaggerated, but we expect modest weakening from here through the end of the year because we do expect modest rate cuts, because we should have a hit from tariffs to a little bit to growth and a little bit of a insurance cut because of the employment weakness.
So against that backdrop, how do you play the U.S. market?
Yeah, so for the U.S. market, clearly, Mag 7, again, we've seen a narrow narrowing of the market, when that's led performance in the last couple of months. What we want to see is a broadening. For it to go materially higher from here, we need a broadening of the market. Earnings season was strong, average about 7% earnings beat. We think sectors that still look attractive are like healthcare, which have seriously lagged. We're waiting for the sector tariffs. Of course, there's a demographic tailwind, and we'll have to wait for that policy risk to play through, but a lot of that we think is priced in. We're starting to see that outperform. So that's, there are sectors in the U.S. that have still lagged this move overall.
Mag 7, again, Mag 7, is it contingent on Nvidia, which has yet to report earnings? Yeah,
I think the Mag 7, it's a good way to phrase it. Historically, I think what's interesting now, it's almost like there's a Mag 3 versus Mag 4. We're seeing more divergence between companies within the Mag 7. And clearly, the companies outperforming now are the ones that have any closeness to AI CapEx, semiconductor spending. So clearly, those are the ones that are benefiting the most, while other ones which don't, or they're in other sectors that are not really related, they're underperforming. So what I would expect going forward, it's more stock picking even within the Mag 7. But clearly, the earnings power there is still strong. It's just converging somewhat with the rest of the market.
How closely are you watching Trump policies when it comes to AI and tech? Because we've seen a lot of changes of late. There's a ban and then it's reversed. How will that impact the way you look at your appetite to invest in AI plays?
Yeah, clearly there's two things. There's the foreign policy risk. I think that's definitely been there for some time. It's intensified, obviously, with President Trump there and the focus on semiconductors. But the key is that this whole reshoring of supply chain will continue, but that's a 5-10 year story. The key is, for us, taking away the political risk is what's the ROI on AI CapEx? Right now, we know all the CapEx estimates are going up. A lot of the MAG players, the hyperscalers, have upped CapEx year to date, even after what we saw earlier in the year. What we want to see is what's the ROI. Clearly, there is an ROI. We're seeing productivity benefits in U.S. corporates, but is it enough to justify further CapEx upgrades?
And in terms of the bond market, how do we play this?
Yeah, so our 10-year yield forecast is 4.25. So we hit that, and now we're slightly above 4.3%. So we think right around fair value on the 10-year, and we have 2 cuts priced in, which is now where the market's priced in after the weaker payrolls data. So we kind of think it's fair value here. So we favor the shorter end of the curve, 3 to 7 years, given the little bit of a rally we've seen in treasuries. But if there is yield pickups, and we've seen it, and the treasuries have been in a narrow range for almost 18 months. Whenever we see the 10-year go above 4.5 to 4.7%, we would lengthen duration to take advantage of it, and that's what we've done in the last 12 months.
4.25. Some say that when it comes to 10-year yields, 4.5 would be, the minimal. If anything, it'll be above 4.5.
Yeah, so if you think about where long-term inflation expectations can end up, which is the key thing to what you're speaking about, we're not seeing a big change in long-term pickup inflation expectations. Clearly, the tariffs are going to create some inflation impact. But could 4.5% on 10-year be realistic media term? It is, but you would need basically productivity as well as employment growth to continue to come down to really drive that. But longer term, when you look at the U.S. trend growth in the economy, it's about 1.5. You add 2.5 for inflation, 2.5, 3, you get to 4.25, 4.5.
Prashant, I just have to highlight the breaking news right now. Japan's 5-year bond auction drawing the weakest demand ratio since 2020. That's against a backdrop of concerns of poor liquidity, volatility in Japan's debt market. Perhaps not surprising, is it?
Yeah, I mean, the bond vigilantes now are out, so we're seeing a lot of focus on bond auctions. It's summertime. It's a holiday week. There was a holiday earlier in the week in Japan. So we saw another auction as well earlier in the week, which was also weaker. So this could continue in the short term. There is less demand in Japan for 10 and 30-year paper because of the demographics of the country. And clearly, people are more nervous globally because all countries have debt about owning 10 and 30-year paper. At the same time, the Japanese yields now are at a level pre this holiday week where you are seeing really a topping out of those yields. But if we see the Japanese 30-year go well through 3%, for example, and hold that, then we become more alarmed about bond vigilantes and in terms of bond inflation risk. But the BOJ is also under pressure to raise rates, probably with wage inflation picking up in Japan.
But the question is whether it will, and when will it do that?
Yeah, so they act very incrementally. There's also we've had issues with politics in Japan. We're waiting for that to shake out. At the same time, wage inflation has picked up. Growth is reasonably strong. So I think they will raise rates, perhaps not on the trajectory the market wants, but perhaps in the upcoming meetings that we definitely think that's a possibility.
So for the year, what are you looking at?
Yeah, we think another 1 to 2 rate rises is definitely possible in Japan.
And what would that mean for the yen? How do you see the yen trading from here?
We see a stronger yen, closer to 140. Or as we go through the year. We've had a little bit of, because of this delay in the rate hikes in Japan, we've had a little bit of yen weakness, and we have a little bit of a dollar rebound because there was such excessive dollar weakness till about a month ago. I think it's natural there's a period of indigestion, but if we look medium term, 6 to 12 months out, we think 140 on yen.
I wonder if the BOJ would also be looking at the Fed, whether it makes those cuts or not.
Yes, I agree. Other central banks take their cue from the Fed, just like we talked about Asian central banks earlier. So what the Fed does is also important before the BOJ acts. But of course, they have their own domestic issues. And inflation in Japan, in my career, is finally well above 2%.
And the biggest risk for the BOJ, you think?
Yeah, I mean, I think because this is a generational change for Japan in terms of inflation above 2%. Keep in mind, just some years ago, we had a real fear, could they even get to 2%? And because they could not for a long period of time. So I think it's a balance between what's happening domestically. Mm-hmm. The good news is the tariff situation is getting more clarified. There's a framework at least. Japan has a rate for what it's worth. We wait for the sector tariff. So that part of the uncertainty is gone. So I think that allows you to say, okay, what is the Fed doing for their own domestic economy, employment, and flip side, what's happening with our inflation.
Prashant, hang tight, okay? Prashant Bhayani, Asia CIO at BNP Paribas Wealth Management, is sticking with us. Let's take a look at Indian markets just ahead of the open. India starts trading in about 4 minutes from here. Of course, we have the RBI standing pat, and that is perhaps expected to be a catalyst for Indian stocks. The Sensex looking to be in the positive in terms of the pre-market session, up about 0.3%. The other benchmarks also in the positive right now. Keep it here with us. This is Bloomberg. India has just kicked off its trading here. Let's take a look at the early get-go for the market there. It is expected to be in the green today, along with the rest of the region. We have the Sensex currently up by about 0.4%. Of course, it is about the CPI print as well. At the lowest level in about 8 years, it gives the RBI scope to cut rates further, provide a catalyst for the market right now. In terms of the Indian rupee, 87.62 is the level we're looking at, up about 0.1% versus the USD. Now, Prashant Bhayani of BNP Paribas Wealth Management is still with us. Back to being the darling, perhaps, India?
Incredible India. So since 2009, India actually, after the U.S., is the best performing major equity market. So from its fundamentals in terms of return on equity, the growth, obviously that story is very clear. The issue now is more valuation level, 22 times forward earnings. That's really at a big premium, about a 55% premium to Asian equities. And Asian equities just got a little too cheap, and we can talk about that. So for us, it's just the relative opportunity. Upside is not as much. Also, domestically, you are seeing a slowdown in demand right now. Earnings season was fine, was about 10% growth, but 2% miss on earnings expectation.
But there are catalysts, right? The RBI could cut rates further. We have retail investors all keen to pump in.
Long term, we completely agree. So there's a domestic retail buying of the market, which is positive for the multiple long term. And also the recent inflation data in India was better. So it opens up perhaps one rate cut between now and end of the year. So there are some supports. So if you got some more relative underperformance, like on the tariff, we see a ramp up on the tariffs. I think eventually they'll probably come to a deal, maybe in the next couple months. That's an opportunity to actually pick up India in the coming months.
In the coming months, but not yet.
Yeah, it's a little early because what we still don't have yet is a tariff deal is probably some weeks, months ahead, but more the domestic slowdown and the fact that earnings season was fine, but it didn't beat, means the domestic story is also slowing somewhat. But as we get a little bit of a derating, which we're starting to see somewhat, and more relative underperformance, that'll open up opportunity.
Is it still a consumption story for India? Would the consumption plays be the one you'd be looking at in a couple of months?
Yeah, I agree. domestic, where you want to play India clearly is domestic consumption, is obviously a long-term story there, which is very positive. There's obviously banks. There's other ways to play that through the financial system. And then also healthcare and IT, if you're more focused on the export side as well. So there's a number of sectors, but it's, of course, broad-based, but the domestic story is the longer-term story.
So Indian stocks still looking expensive. When it comes to Chinese stocks, that's a different story. Looking very cheap, some say still, and perhaps some quiet resurgence that we're seeing right now.
Yes, and we've been overweight China even when it was unfashionable last year. But we're starting to see that come through. It just simply got way too cheap, and obviously people were very underweight from a positioning perspective. This year, the DeepSeek was a wake-up moment. Earnings delivery is okay, but the key is the domestic side, the property market hasn't bottomed yet. Tier 1 city property prices have bottomed, but not Tier 2 and 3. When that does, then you really get a bigger bounce. But what we think right now is, from a stock picking perspective, domestic consumption in selected areas, domestic brands, selected areas of tech. Clearly, they got too cheap, and we're seeing a re-rating of it before the earnings growth picks up in a major way.
You talk about how the property sector is still an issue. Evergrande, is about to be delisted from the Hong Kong Exchange because of the debt level higher than it first reflected. I mean, that shows that the housing woes are still not done.
That's correct. So we are still staying away from fixed asset investment related property market. So we're definitely sticking more consumption, tech, telcos, because you get dividend yield and you get share buyback and you're aligned with the government. So those areas we favor, and that's what we've liked, and those sectors have done well. But when you get close to the property sector, we're not convinced yet. We've seen a bottom. There is more stimulus coming, which is another reason why the market's outperforming, is that we're starting to see more stimulus. But as you know, in China, it's incremental and it's over time. And until we have a tariff deal, and we have to wait another 90 days likely, you won't see consequentially a huge one-off stimulus.
But it's also the national team story. It's pumped in a lot of money to provide that boost. I mean, should we be concerned that perhaps this is a market that's being propelled by, domestic players, despite how the fundamentals look?
Yeah, I think the key thing is that was really an insurance. During April when we saw the tariffs ramp up, we saw domestic buying likely pick up in the southbound flows out of Hong Kong. Medium term, what's really interesting is Hong Kong IPOs. So we are seeing a pickup in healthcare and tech and other areas, and there's capital coming in also from private investors from mainland China into Hong Kong. So the domestic support's there, and those southbound flows are strong, and then the strongest in 4 years. And obviously we went through a very tough period. So we are seeing a change in mentality from also mainland China and Hong Kong investors, and the Hong Kong capital markets actually, frankly, are pretty impressive, up over 20% year to date, and the IPO activity is a good indicator of investor risk appetite.
What's being underlooked? What should investors be buying that they're not buying yet?
In China? Yeah, I think China, clearly, when we have that turn in the property market, you can get more bullish, broader outside some of the sectors we talked about. The other thing is within China is we've been talking about excess capacity, because the big problem with China is great companies, but we have overcapacity and we don't see the pickup in profit margins and profitability like you see, for example, in the U.S. If we see a more considered move towards reducing excess capacity, that's very positive for China equity market profits and longer term profitability, because that is a key issue, medium term in terms of return on equity. That's why, for example, India, the U.S. have a very high return on equity. That's why their stock markets perform much better.
Prashant, great having you with us. Prashant Bhayani, Asia CIO at BNP Paribas Wealth Management. Now, Bloomberg has learned that India and China may resume direct passenger flights as soon as next month in a move toward resetting political ties. Routes between key cities were suspended after the COVID pandemic. Let's bring in our India aviation and infrastructure reporter, Mihir Mashra. Mihir, India, China have announced resumption of flights in the past too. Has it moved beyond mere announcements this time?
Yeah, there have been announcements in the past in January and June this year, but nothing translated into actions then, post both the announcement. But this time it looks a little more serious than those earlier announcements, because, the airlines have been asked to prepare themselves, at least the Indian airlines from the Indian side, the Indian regulator, the Indian aviation regulators asked airlines to prepare themselves for flights to China, and they might have to deploy flights at a very short notice. Now, this is clear development which we had not seen in January as well as June this year, when there were formal announcements made by the top officials of both India and China. Yes.
see this announcement? How soon do you think that may happen?
Yeah, so our sources tell us that the announcement might happen at the SCO summit where Prime Minister Modi is visiting, and he's also likely to meet the Chinese premier at the SCO summit being held in China. Now, the preparations for the flight launch along with other announcements that may happen at the summit are on. We are told that there are meetings within the government in India, the External Affairs Ministry as well as other ministries which are involved are discussing it. There will be a final meeting before Prime Minister Modi leaves for the SCO summit, which is when all these details will be finalized, and a final announcement is likely at the SCO summit. Post the announcement, we expect Indian Airlines and also the airlines from the Chinese side to start operations, say, during September of this year, hopefully. Unless something happens in the relationship between the two countries, September is a likely date for launch of flights.
Meher, is there a sense of which Indian airlines are likely to launch flights?
Okay. Yes. So there are two primary airlines in India. One is Air India and the other is Indigo. Now, both Air India and Indigo have been asked to prepare themselves for flights to China. Both these airlines are preparing for flights to China and will launch flights to China. Now, between the two airlines, Air India is a bigger airline with more wide-body aircraft. So that will be the airline which will have a larger share in the India-China flight market. Indigo, which doesn't have so many wide-body aircraft, will be a smaller player, at least in the India-China sector initially. So we'll see a large number of flights coming from India, followed by Air India, followed by Indigo. And from the Chinese carrier sides, at least 3 airlines which used to operate before the flight suspension happened are likely to resume flights, including Air China. All of them may not start flights at the same time, but expectations are that we may see some flights, flight announcements happening. Yeah.
Meher, thank you so much for that. Our India aviation and infrastructure reporter, Meher Mishra. Taking a quick look at Asian benchmarks, we're seeing a rally for HS Tech in particular, lifting the Hang Seng Index by almost 2% right now. We're also keeping an eye on Tencent earnings, which could provide a catalyst for HS Tech. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.